Hi, good afternoon. Welcome to the marketplace. Coming up, Fitch Solutions warns Ghana's banking sector is vulnerable with high non-performing loans and low capital adequacy ratio. We will discuss the implications. Also coming up this afternoon, government fails to meet its treasury bills target, but interest rates fall again. We'll have an update. Plus, MTN Ghana shows all Momo accounts are safe and secure to undertake any form of transactions. My name is Darryl Kwao. Thanks for being with us. Details coming up. Now, Ghana's banking sector is particularly vulnerable with a high non-performing loan ratio of 21.8% and a capital adequacy ratio of 14%. According to Fitch Solutions, this is a result of the domestic debt exchange program and high interest rates. In this paper titled U.S. Tariffs Increase Risks for SSA Banks, that's Sub-Saharan Africa banks, Ghana has the highest NPLs among the 10 top Sub-Saharan African countries, whilst its capital adequacy ratio is the third weakest. I'm joined on Zoom by Manager Macroeconomic Research at GCB Bank PLC, that is Courage Buti. Good afternoon to you, Courage. So Ghana currently has the highest non-performing loan ratio among the top 10 Sub-Saharan African economies. What are the key factors driving this trend, and how worrying is it for the health of the banking sector?
Well, good afternoon to you and your listeners. We have gone through a phase, as we all know it, with the domestic debt exchange, the deterioration in the macro economy and the operating environment for banks, which made it difficult for, if you like, borrowers to be able to service their debt on time. We've seen at some point inflation soar to over 54%. We've seen exchange rate pressures, and we've seen general cost of living crisis in the domestic economy, which made life generally difficult for everybody. Those are the backdrop to, if you like, the high NPL levels, the deterioration in CAR, because most of these banks hold significant portion of government of Ghana bills and bonds, and with the restructuring and then the haircut and tenor extension, it meant a lot for their capital position. The reason Bank of Ghana had to even give the concession for, or what you would call forbearance on the capital adequacy ratio, reduce it from 13 to 10%, which is running until the end of this year. So banks are really in that recovery mode, recovery phase. Some are ahead of the curve, some are just about meeting their minimum capital requirements, and they still have some work to do together. But the special circumstances we've seen in our economy is not what we've seen in other economies around Sub-Saharan Africa, really. So yes, it's only understandable that we would have NPLs at the rates we have them. We have at the levels we have them. I think what is encouraging is that it is on a clear path of correction, and capital positions are improving, which is why Bank of Ghana, I believe, for some time now has suspended their interest, if you like, dividend payment for most of these banks to allow them plow back profits into their capitalization drives and all that. So we are in that recovery phase. I don't think there is much to be concerned about this point. The worst is behind us, and then the trend now looks a lot more positive than it was a few years or months back.
Just wondering though, with the capital adequacy ratio of 14%, how close is it to the regulatory minimum, and what are the implications for financial stability, if you like?
Well, the regulatory minimum, as we know it before, the forbearance was 13%. And so at 14%, it means the industry overall is ahead of the regulatory requirement. You need a bit of buffer to be able to take more risk, and that is what banks must build now. Currently, as we speak, the minimum is 10% because the forbearance is still in place until end of year. So if you look at it versus the 10%, then probably banks are ahead. But we know that the correct place should have been 13%. A number of banks, I must say, already ahead of that. There are still a few banks, mostly the state-owned banks, who are beneath that and need some extraordinary interventions. I think the governor didn't shy away from talking about some of those institutions in the last MPC press conference, really. So there are institutions that need support. There are institutions that are still struggling, but a good number of the banks, the private ones, and then the big names you see around, most of them have crossed that mark and are comfortable with capital adequacy ratio. The reason, like you would know, my bank, GCB Bank, actually announced a 1 cedi share uh, uh, dividend per share last week at the AGM, subject to Bank of Ghana approval, if that goes through. And I know last year Stan Charts declared dividend because they are well above that. We know a number of the other brands are also ahead of the curve in that respect. And those are the trends we are seeing. So it is not the universal thing. At this moment, it's just a few institutions that have issues. And once they address it, I think we should, as an industry, see ourselves clearing that line by December 2024 and 2025.
All right, and Fitch Solutions in this same report expects interest rates to fall this year. How might this affect loan quality, credit growth, and also the profitability of the banking sector?
That assumption underpins the correction in NPLs to a very large extent, and we've seen at the treasury side of the curve the correction ongoing. We've seen T-bill rate at the lower sides of 15 now, and clearing the upper side of the curve, clearing below 18. That's a positive sign, and if that is an indicator of cost of funds, then you expect that lending rates will begin to trend down as inflation trends down. Government is looking at 11.9% inflation. BOG is looking at 12% inflation. We've seen CD stable, in fact, correcting to some large extent in the last few or so months post-elections. All of these bode well for rates to come down, because what it means is that cost of production will be lower for cost of input to be lower for most of these entities, the cost of funds to be lower for banks, and then there will be the appetite to invest more. And given the liquidity in the system and the need for banks, especially when T-bill rates are plummeting and there are no options on the market, banks, if they see correction in the macroeconomy and confidence returning, will be inclined to expanding their loan books, and they would have to compete for prices, really. And that is where the interest rates will begin to come down. So it hinges on a number of things. Inflation is a key part. Exchange rate is another. The general macro outlook is another. And as we speak, I think all of these are pointing to the right direction. So it's a matter of time inflation will follow suit, and we'll begin to see maybe some sharp decline in lending rates across the curve, which will now support the business community to create the needed jobs for the society.
Well, another line I found interesting in the report, I'm going to read it too, says U.S. tariffs will impact banks in relation to monetary policy, and thus Fitch expects banks to face increased uncertainty as policy expectations shift. Your thoughts?
Well, as a matter of fact, I mean, how is the monetary authorities interpreting what is happening with the Trump trade tariffs? As an economy, as banks, how are we affected? The channels we are affected will be through trade, the trade to finance, the import to finance, what it means for cost, and whether those importers will continue to do the businesses as they do, or exporters, whether they will do it as they do. That is one channel it impacts. Another channel, I believe, is that just like the whole world, everybody's affected by tariff some way, somehow. We happen to be at the lowest end of the curve. Now, the Chinese manufacturing concerns and the many other economies that are hard hit by the tariff to the point where it's become unbearable or almost drove them out of competition into the US market. Will Ghana look like a potential base for these people to pitch camp here and then produce and then export to those markets and then enjoy the lowest possible tariff rather than produce in their local jurisdictions? Those are avenues and opportunities open to us that GIPC and then the government and then monetary authorities can try to pitch in their investment pitches to other economies. And I mean, your Chinas and the likes who are hard hit by this, to consider Ghana as a destination if they still want to keep producing and exporting to the US market. These are the dynamics we need to look at. So I wouldn't look at it from the negative side of things in terms of how it impacts policy alone. Yes, it has some impact, but there are also some positives that if we package and position ourselves properly, we should be able to tap into. And I expect GIPC, the government of Ghana, and then the appropriate authorities to look at a holistic picture of what could be the possibilities and how we can tap into it to our benefit. By all means, increased cost of export may mean something for us, but there are also opportunities we can tap into, and policy must be looking at that to harness those benefits to the maximum.
Yeah, and let's look forward. What regulatory reforms or interventions would you recommend for to improve NPL ratios and the capital adequacy boost here in Ghana? Also, what should banks do with this warning? I mean, how should banks restructure or manage this exposure?
Well, so we have enough regulations, enough. The systems are robust. I don't think NPLs are going because are going up because banks are weak risk management structure. It just so happened that what looked like good credit maybe a few years back, all of a sudden is impacted by the macro dynamics, the economic dynamics we have, and there is very little anyone can do about it. So banks will continue to be robust in their risk management approach. The improvement in the economy, the stability emerging, the easing cost of living conditions will ultimately support NPLs to start performing again. But going forward, and that is an important point why the IMF is at pain to say that the LD ratio, in fact, the CR, cash reserve ratio linked to LD, loan deposit ratio, is not an optimal decision. The reason is that if you are a bank that is not so, your risk culture is not so strong and you are not too minded to be cautious how you advance credit and all that, you might be expanding credit in the name of trying to go into the lower brackets of CRR at the expense of appropriate risk management. And so the requirement is that review that, possibly take that off. And the governor at the last MPC meeting hinted that they are reviewing the process. I envisage that given the liquidity conditions on the market and then the impact, balance sheet impact of probably extra OMO operations at a higher cost, maybe it might not be prudent to reduce the cash reserve ratio drastically. But then what they can do is at least they link it from LD so that banks, if they choose to advance credit, it's not motivated by get some LD ratio and then move to a lower tier of CR, but it will be a usual business decision to make based on your objective risk assessment. And I think that is something Bank of Ghana can do to wash its hands off maybe what someone could interpret as Bank of Ghana motivating credit expansion, which maybe connotes that it's coming at the expense of proper credit due diligence or due processes and credit advancement, really. I think that is what we expect. I believe in the May decision, there should be some conversation around what to do about LD and then CRR. And I expect that it will be linked in that regard. But that said, I believe banks are very robust in their risk approach, and it will not be justified that you are moving into a lower LD bracket at the expense of all the prudence you need to exercise in credit writing.
All right. Thank you so much for your perspective and your analysis. Courage Wuti, he is Manager of Macroeconomic Research at GCB Bank PLC. I appreciate your time. You're on the marketplace. Now, we're turning to the financial markets. And the government failed to... All right, so the government failed to meet its Treasury bills target after registering an oversubscription a week before. That's according to auction results by the Bank of Ghana. Interest rates, however, fell again. Head of Trading at Republic Securities, Patrick Edemagama, joins me on Zoom. Patrick, let's begin with a rundown of last Friday's auction.
So, Daryl, we noticed that the government fell short by 1.59 billion Ghana cedis last week because amounts submitted were 4.73 billion against a target of 6.43 billion Ghana cedis. Despite falling short, we noticed that about 200 million were rejected for the 182-day, and then about 360 million were rejected for the 364-day. The rates, we saw that the 91-day cleared at 15.23, dropping by 8.76 basis points. The 182-day cleared at 15.77, dropping by 25.97 basis points. And then the 364-day, for the first time, we are seeing it trading below 17%. It cleared at 16.95, dropping by 141 basis points.
Yeah, so explain to our audience, because we are told the government rejected 563 million Ghana cedis in bids during this undersubscribed auction. Explain to us the government's thinking, and does it align with the current market appetite and the liquidity conditions?
Yes, I would say so. I would say so. What we saw happen last week is that the BOG collected about 3.3 billion off the market. So liquidity went down a bit on the market. And also for people or investors bidding high, the government has still, again, showed its appetite to keep the rates low. So we've seen investor sentiment also improving in the fact that people are willing to bid low yields and show that there is confidence in the macroeconomic stability and inflation control. We are also seeing that for the 364-day, for instance, the government was able to get that basically because of the non-competitive bids. So you see that the non-competitive bids were very low. So it should tell you how low investors are willing to bid to be able to buy these securities.
Meantime, interest rates are falling by just how much, really? How significantly?
Well, it's quite significant to lose about 141 basis points of interest rates then for a whole year. Should tell you investors' perception of where they expect the rates to be. Again, that should also send a signal to the Monetary Policy Committee that investors are willing to actually get interest rates down, and hence the monetary policy should also move towards that same direction.
Yeah, and so what's the outlook? Because last week there was an oversubscription, and now, last 2 weeks now, last week there was an undersubscription. For how long are we going to see this go on? What's the outlook for the next few months or weeks, if you like?
Well, it's pretty clear that the finance ministry or the government is not willing to accept high rates. It's just about time for every investor to understand and accept it. Luckily, there's also some stability on the exchange rate front, so it makes CD investments quite lucrative. So investors must accept where the appetite of the government is and be able to follow same. Because every week we see that the rates that are high are being rejected, and we've seen it from beginning of the year to date. So the statement is a bit clear to we, the analysts on the field. We can see that the government is not willing to budge at all. And we are also monitoring how they are going to meet their obligations. And so far, they've been able to do that. For this particular week, we expect the target to be 5.3 billion. The obligations at stake is about 4.7 billion. So if they're able to achieve that 5.3 billion, it gives more liquidity for other future obligations. So investors must come to terms with the fact that the government is not willing to come.
All right, switching to the stock market, our eyes on MTN Ghana. What's happening there?
Well, we are seeing that MTN, there's a lot of bid mounting for MTN. We have seen price moving up already today to 3.13. Bids are as high as 3.15 with limited offers on the market. So MTN is leading the gainers. And on the other side, the sell side, we've seen offer mounting for Car Bank. The offers are mounting and we expect some decline. Last week, we saw MTN, Societe, and ETI gaining some pesos. And then we saw Car Bank, New Gold, and Total also shedding some pesos. So we expect this trend to continue for this week as well.
Anything else you're watching on the market?
Well, another thing too is the other banking stocks. If you look at the banking stocks, I'll say all financial stocks, including insurance, so banks and insurance, we have seen that they are actually having a lot of demand in them. It's time for some people to cash out. So people who want to sell their banking stocks will be able to have people ready to buy them.
All right. Thank you so much, Patrick Edemagama, Head of Trade and Republic Securities, speaking to us. I appreciate your time on the marketplace. All right. We are heading to a break. When we come back, we have some more stories for you on the marketplace. Don't go anywhere.